IMF warns, U.S. tariffs threaten global economy. The International Monetary Fund, IMF, and other leading financial bodies have issued sharp warnings that rising U.S. tariffs and the ensuing policy uncertainty represent a major, persistent risk to the global economy. Although the world has shown resilience, the IMF cautions that this stability may be tenuous. This video breaks down the specific channels through which U.S. protectionism is slowing growth worldwide, complicating monetary policy, and eroding the multilateral trading system built over the last 80 years. The inflation and growth trade-off. The IMF analysis points to a direct cause and effect in the U.S. economy. Tariffs are a notable source of inflation risk. By increasing the cost of imported goods, businesses pass those costs on to consumers, complicating the Federal Reserve's efforts to hit its 2% inflation target. The U.S. growth forecast for 2025 has been cut significantly, from a peak of 2.8% down to 1.8% in some IMF forecasts, with tariffs accounting for a measurable portion of that reduction. The central bank faces a delicate balance. Cutting rates risks entrenching tariff-driven inflation, while delaying action risks worsening an economic slowdown. The paralysis of policy uncertainty. Beyond the direct cost of the tariffs, the IMF and OECD emphasize that policy uncertainty is the major driver of the economic outlook. The unpredictable nature of the tariff announcements discourages business investment, causing companies to pause near-term expansion plans and cut spending. Economists note that this uncertainty weakens trade and investment flows globally, creating a palpable climate of caution that curbs growth prospects far more effectively than the duties themselves. Global financial contagion. The impact of U.S. policy extends through global supply chains and financial markets. The IMF warns that the rise in U.S. tariffs contributes to financial market volatility on a global scale. This tension causes interest rates to rise in other countries, increasing borrowing costs for governments and companies. Emerging market economies, which already face the highest real financing costs in a decade, now must fund debt refinancing at higher costs, increasing fiscal fragility and threatening financial stability. Trade decoupling and regional slowdown. The IMF notes that the surge in trade tensions is forcing a slowdown, concentrated in regions highly reliant on the global system. This includes East Asia and the Pacific, where growth is projected to slow, and Europe, where projections have been revised downward due to tariff-induced trade friction. Furthermore, the risk of a second round of tariff hikes remains, where countries targeted by U.S. duties retaliate with their own measures, further fragmenting global supply chains. A call for multilateral cooperation. IMF Managing Director Kristalina Georgieva summarized the current reality as better than feared, but worse than needed. While global resilience has been demonstrated, the organization's core message is that the only sustainable path forward requires abandoning protectionism. The IMF urges the U.S. and its partners to work constructively to resolve trade tensions, restore confidence, and commit to a predictable, rules-based trading system to safeguard long-term global growth, which remains forecast at its lowest level in decades. Conclusion. The U.S. policy of aggressive tariffs is resetting the global economy, moving it from integration to fragmentation. The IMF's warnings underscore that protectionism is a shared threat, one that increases financial risks, slows growth for all, and demands immediate global cooperation to reverse the current course. If you enjoyed this deep dive, follow and subscribe the channel for more videos like this.